Hi, I'm Toni Janko with the Janko Realty Group. Thanks for joining us in this video series. In the previous video, we discussed the 4 documents that are needed to attain a pre-approval letter. In this video, we're going to dive a little bit deeper into one of the crucial items, and that's your credit score. Joining me today to discuss credit scores is going to be my partner, Toni Eads, and again, Brandy Jones of Union Home Mortgage.
So let's start with the also common question of a buyer of what does my credit score need to be in order to get approved for a mortgage?
Sure, so it really depends on the loan, but the lowest score that we can take is going to be a 600, and that's if you're using FHA or VA. We'll need to get a 660 if you're going to use any kind of down payment assistance or maybe USDA or even those 3% down conventional loans. If you're looking for a conventional loan, we'll need to have at least a 620.
So how does a person's credit score affect the interest rate that they're going to get on their loan?
So the credit score does affect the interest rate, but keep in mind that there's other factors that impact it as well, such as loan type and also that loan amount. So when it comes to the credit score, though, with that being such an important part, just keep in mind that the lower your credit score, the higher your interest rate, generally speaking. But the good news is that the difference between a low credit score and a high credit score could only be about $10, $15, $20 a month.
So you spoke of how a credit score is going to affect somebody's monthly payment and the type of loan they're going to get. Tell me how that credit score is also going to affect the amount of loan that they're going to get.
So the truth is, when you get pre-approved, you're really getting pre-approved for a monthly mortgage payment, not necessarily the purchase price. They're really looking at the monthly payment. So when it comes to the purchase price, of course, if you're going to have a lower score, a higher rate, that's going to then impact your monthly mortgage payment, make that a little bit higher, and in turn, you're going to be qualified for a little bit lower purchase price.
Okay, so if someone doesn't quite qualify for a loan or they want a better mortgage rate, if they have to repair, fix their credit, or even build their credit, what are some of the things that they can do?
Sure, so the first important thing to do is go ahead and let me pull your credit, because even if you have things like Credit Karma or something like that, although they're a great resource, the score that they pull in is going to be inaccurate compared to what we look at for the mortgage. So once we have that, everyone's credit report is a little different. It's kind of like a thumbprint. Everyone has different things that they need to work on with their particular credit report to get it fixed or maybe repaired or even just to build it. Whether that's paying down collections, paying down balances, or maybe even some people who need to build credit, we may see if they could open up a secured credit card, which will give a quick boost to that score.
Brandy, can you provide the viewers with some helpful tips of what they can do with their credit score?
Absolutely. So first, of course, make sure you keep those balances on your credit cards under 30%. Make sure if any collections pop up that we pay those off. And again, if you need to build credit, it's always good to open a secure credit card that'll give it a quick little boost. Also, make sure that you don't have too many hard inquiries. So don't have too many people pulling your credit. Like when we're out Christmas shopping, make sure you don't say yes and let everyone open up a new store card for you.
I am guilty of that.
Thank you, Toni. Thank you, Brandy. We hope you enjoyed this video and found it both useful and informative. Make sure to stay tuned for our next video when we're going to play a little game that we like to call Income Myth Busters. Thanks!